Go into one specific stock trading at just over $6 that I believe has extreme upside potential. I believe this might actually end up being the next crazy AI runner, and it's going to be one that you're going to want to know if you're in the markets for the next few quarters. The stock has a very similar business strategy to Palantir. It has a huge proof of concept. It has huge upcoming catalysts. It has a super small market cap, and its price is down significantly from all-time highs. I'm going to make the case for it, explain the business, upcoming catalysts, strategies, and we'll also go into the risk as well. And then I'll leave you to be the judge. As always, if you're the one taking the ultimate risk, you got to be the one doing the ultimate frisk. Always do your own due diligence on all ideas presented. Okay, so for starters, I just want to take a moment to say Happy Veterans Day and to appreciate all of our veterans. I also know that we have a lot of both active and retired military folks that watch this channel, and I do want to make sure that you understand that you're very much appreciated. Okay, let's get to work. So market context. Now, in the last video, I gave a long, in-depth breakdown of why I believe the next 45 days to the new year is a critical time to position yourself appropriately for 2026, and you really need to internalize this because what's going to happen is a big stinking deal. Now, there is no shortage of media ping-ponging back and forth between fear and greed on what seems to be now a daily basis. But folks, this is all just noise. When you shut out the noise and you focus on the bigger picture, 2026 is going to be an extreme opportunity for growth. And what does that mean? It means preparing now. Why is 2026 such a big opportunity? For starters, AI capex commitments in the trillions of dollars, company earnings continuing to skyrocket, rate cuts incoming, an even more dovish Fed chair replacement coming in May, a midterm cycle liquidity boost, the many trillions of dollars in sideline cash, money printing, pumping assets. 2026 is going to grow many people that are prepared, and it's going to absolutely destroy folks that weren't prepared and couldn't think for themselves. If you're somebody who is new to markets, you need to know that 2025 has been an unusually consistent year. Besides the massive dump in April with the tariff crash, we've gone basically straight up with very rare setbacks in the overall trend, and that's what I would call a sweetheart market. Yes, I know the media and the experts fear-mongered all year, and back in April, anyone who bought the dip was considered a foolish clown, but nonetheless, as far as bull markets go, this was a sweetheart market. Now, 2026 is setting up to be an even more extreme opportunity than 2025. However, it's also going to be way more dangerous. I'm going to make a bold prediction here, and I'm going to explain it in a second, but my prediction for 2026 is that overall, you're going to see a massive uptrend, but you're going to also see more frequent and severe dumps. I think 2026, you're going to see multiple 10 to 20% drawdowns, perhaps a major 30% plus drawdown if we don't get that regular breathing. Why am I making this prediction? What's it based on?
Okay, so Gucci is a partner. Gucci items are consigned through RealReal. Partnership with Salesforce. I can do a little comparison with Poshmark. Excuse me. Okay. So this is how recent is this IPO? 2021. Okay. $16. It's very close to its IPO price. What price did it IPO at? Okay. $20 per share. That doesn't look like what it IPO'd at. This low is $13.68. Doesn't make any sense. This open is $14.04. What are you talking about? Anyway, let's get going here. We're already 5 minutes in. So, outperforming its peer Poshmark in GMV and revenue. Okay. This stock will surprise everyone. This is not financial advice, but my research suggests it's a good idea to buy $50 of this before November 22nd. The ticker is REAL, Real. The company is The Real Real. They're a luxury retail reseller. They have a partnership with Gucci, so you can buy Gucci bags through Real. And they have more GMV, gross merchandise value, revenue, amount of products sold in dollar terms than Poshmark. Also have a higher growth rate than Poshmark. Poshmark, more well-known than The Real Real. I'm not a woman. I do know that a luxury retailer, reseller, growing really fast is a pretty hot segment. Let's jump into the chart. The price right now is very close to the IPO price from 2021, the tech end of bubble, and now could be an important level to get in. It's not financial advice. Let's get started with The Real Real.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
So this is a little bit about The Real Real. They focus on authenticated luxury resale, big brand partnerships like Gucci, and also strong tech operations. So they do have a partnership with Salesforce. So this is in opposition to Poshmark, which I don't know that Poshmark would call themselves low end, but you've probably heard of Poshmark. You've probably seen them. And they definitely are mass market. So Lululemon, as well as Victoria's Secret. Yes, Gucci is on here as well. But a lot of these brands, maybe not quite as luxury as The Real Real. And we can take a look at this website just to get a quick eyeball of what this is. But God, this is obnoxious, huh? Well, maybe this is by design, actually. It's pretty impressive that you have to sign up just in order to even see the website. And they have so much gross merchandise value. So let's see if this works. No, let's just abandon ship. This is the company, more than 20 million members. So another differentiating factor is I wouldn't associate Poshmark with having members. But before we pretend that we're retail experts, let's just jump into the chart and see why I'm talking about this company in the first place as a stock picker. Here's the recent earnings result. Pretty awesome. Pulling back to a little below the close. If it gets over this close, that's a really solid spot to risk. And how that works, that level is about exactly 15.5. People bought all through here. You can see all the volume way higher than through here. So there's buyers distributed through that whole price range. And so if the price gets over that level, they're all in the money. They all are making money. So if it goes down, they're more likely to sell, okay? If it stays up, they're less likely to sell. And there's a lot of them. So that's basically how that works when you have a high volume, literally, close. There's the close. So that's the setup, if you can call it a setup. I think you can. And you can see it sort of broke out over this left side peak, little undercut and broke out. So on a 5-year, sure, we are very close to the IPO price. If we look at this weekly chart, we can see the low up here. If you look, you see it's like 13.7. So it's above the low. And now there's a lot of blue skies into this initial IPO euphoria. So that's the idea. If we look at Poshmark, the performance is not great. So the Real definitely looks more interesting. If we look at a daily chart here, it's also not particularly even trading. So that's not even a fair comparison at all, is it? Let's take a look at what's going on here and what tickers we can actually compare to the Real, considering Poshmark is delisted. All right, so this was the IPO price right here. $20 was the actual price. We saw on the chart it went as low as 13 and change. 300 million normal IPO type banks. If we look up and take a look at needs, not a lot of needs. No cash need, and not a lot of risk of raising money as a result. Those can go hand in hand. So that's really good news in terms of deciding to buy this company. And here's basically, I guess, the new Poshmark. Etsy is probably most similar. ThreadUp, also in the same ballpark. But you gotta wonder if Poshmark is not trading anymore. Maybe these other companies are not quite as exciting either. Etsy, pretty unfortunate earnings. This is a great example, actually. I'm obviously revealing how little I know about retail and how much I'm biased on actual charts, but this, we didn't know what was going to happen with earnings here, right, with Etsy. So I had been looking at this as a breakout opportunity, right? This flag was really lovely at a time when there was almost no flags. It just so happened this 10-10 day contributed to this flag. And sure enough, it did break out, okay? Which is great. You know, maybe you got 10%, but you had to be really nimble. So this is why you don't hold into earnings. That's just a little side effect that we got to take a look at that in this breakdown. But there's the Real. Talked about the levels. And that's the idea. If you like these ideas, hit that like button. If you want a free course on how to buy stocks before they go up, not totally based on fundamentals, to be honest, hit that subscribe. And if you want one-on-one help, head over to stockscommunity.com. I'll try not to hit the microphone in future videos. See you in the next one.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
It's based on one thing: margin. Margin usage is going to dramatically expand in 2026, and that's going to have far-reaching consequences. Right now, margin usage is already at all-time highs. The margin situation for 2026 is as follows. Margin leveraging will surge with lower rates. Margin debt is already high, but with lower and lower rates, margin usage will go through the roof. Margin will become cheaper and cheaper again in 2026, and the lower the rate, the more obvious a deal it is to take out margin and buy stocks. If the S&P 500 returns 10% on average and rates are well below 10%, while many market participants and fund managers make the call that it makes a ton of sense to use margin to buy more and more into the market. Many managers are already doing this because tech stocks have been returning 3 to 4x the average of the S&P 500. So they're thinking, okay, well, if we take out a lot of margin at 10%, at 8%, at 12%, and we're buying into Nvidia, which goes up 40%, well, that's a good deal. But imagine what's going to happen as these rates get cut more and more and more and get cut to half of what it's at now, and probably even lower if you're looking out multi-years. So why does this margin situation mean that markets are going to become more volatile? Well, you have to understand that margin is a double-edged sword. People utilizing a lot of margin can make many multiples of their money for every 1% upswing in the stock market. And so what happens? Well, you end up having a lot of these players go,
Okay, well, margin. I don't really have any comments on margin. It's kind of besides the point. Okay, you still gotta pick the stocks that you think are gonna go up. So Your connection to Trump is the subsidies were not lowered as much as expected. Strong Q3 for FSLR. 400 million, 70% year-over-year growth in revenue. 70% year-over-year growth in revenue. Pretty exciting. Pretty exciting. $2 billion of orders, contracts executed. That's a backlog, is what that is. Okay. So that was in August, or you say pop in August? Yeah. Pop in August for these other ones as well, right? Triple check that. All right. Trump's energy stocks will help you retire. This one solar stock had 300 million in revenue, up 70% year over year. They also have a nearly $2 billion backlog of projects. Solar stocks were expected to get hit a little bit with the Republican administration. What happened in August instead was statements were made that subsidies would not be cut nearly as much as thought. Solar stocks have since gone on a run. The one stock that hasn't run as much yet, ARRY, Array, and this company recently had earnings, is holding at an important level. So while its peers, First Solar, Next Tracker, are up significantly, this stock is still underpriced. Let's jump into a little breakdown.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
All right, so this is Array, ARRY. Here's the recent earnings. This is around the time where that news about subsidies not being cut nearly as much came out. If you actually look at the TAN, which is the solar ETF, you do see a little bump there. And of course, looking at the individual stocks, First Solar is offering opportunity here, but it's up a lot. Next Tracker did have an opportunity here, but significant selling off today makes it tough to come up with any ideas right here. You still want this level as risk, and right now it's in no man's land. So the best idea right now has to be ARRY. So here it is after this recent earnings sell-off. It's not nearly up as the others. You can see it's basically at that August initial jump. And so there's a lot of room to grow here. Now, as far as where to buy it, sure, the easiest spot to buy it would be, over a whole psychological number level, like 9, which it is basically. There's been some price agreement at 9 for a while. So could it just not get there? It could, but I do think this one is nice to have on your radar. There's obviously a big benefit for solar given the administration, and this one is one of the few solar stocks that hasn't run up yet. So That's the spot. And if we kind of look at how these stocks all work together or compare, here's a little comparison. So they do solar tracker systems. First Solar focuses on solar installations, and another company, NEE, I actually didn't mention, also has some nuclear capabilities, but I don't think this is quite as interesting personally. This earnings reaction is pretty gnarly. It is at a key level here, but I do think focusing on a stock that's much similar to these stocks that have recently run up a lot just makes more sense. So it's sort of a pure play, and you might say that's not a lot of money, 400 million. Well, it is up 70% year over year. The earnings per share did beat the estimate, and they have this backlog, okay? And their products are part of that. So we'll see what happens. Tariffs are a serious problem for solar panels that are produced overseas. But all in all, this is a solid set of numbers. Despite the reaction, it's pretty solid. So this is another bit that's going to come into play, the data center play. And what we are seeing right now is that money is in biotech, okay, continuing to move up a little bit today, even as the market was not super strong, actually a little red. And then banks as well, XLV, XLV is actually healthcare. I'm going to have to be a little more careful here. XLF is the banks, but very strong there as well. So banks and healthcare, biotech strong. And if we look at some metals, strong as well. Okay. So gold, big recovery. As far as other major parts of the market, though, NVIDIA just building out a base, and then Palantir failing to break out or, offer an entry opportunity here. So, you know what? I don't know that there's really a sector that's more interesting. This is defense and drones, KTOS. You can see that in companies like UMAC or RCAT. These speculation names have sold off, rare earth names barely bouncing, selling off some more. Quantum names, of course, pretty cooked beyond oblivion. And so you have to think what's left, right? If the Bitcoin miners turned AI data center names are selling off, Mara and Riot being the poster childs of those, it has to be solar. I mean, the ETF looks strong, and you can't necessarily buy biotechs when you see companies like HIMS continuing to sell off after earnings, QURE barely bouncing. I mean, not that you would buy it down here anyway. This is the gnarly FDA result. And then recently that CRISPR company, genetics company with that big patient, Hims law or whatever, the patient had a big side effect. I don't think he died, but this is a serious hit for this company. So solar has to be it. And, whether by process of elimination or what, ARRY is the stock that hasn't caught a big bid yet. So that's the idea. If you like these ideas, hit that like button. If you want a free course on how to buy stocks before they go up, hit that subscribe. I post that once a month for subscribers. And if you want help with your portfolio, head over to stockscommittee.com. Take a look at a couple testimonials there, a review, and try it out. It's $25, super affordable 7-day trial.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
All right. So let's jump into a little more.
And they
Charles.
take out massive amounts of margin to further ride stocks that are already going up fast, which causes those stocks to go up even faster. And it causes them to make money even faster, which is great, and you get a huge melt up. But then what happens? Well, you're multiplying your gains to the upside, but you've also multiplied your losses when things are going down. And just like every percent increase is multiplied with margin, well, every percent decrease is multiplied with margin too. And unlike on the upside, well, on the downside, you could get margin called, which causes these situations where you have these massive runs and then all of a sudden, boom, a crash. Now, overall, again, I think the entire year is backstop, so dip buyers are going to be nowhere in short supply. However, for folks that really just want to buy stocks and then just ride it slowly over time and then not have any volatility, this is not going to be the year for you.
Twilio, revenue up 15% year over year. They've got some AI products for sure. And acquired an AI agent. Multi-year strategic partnership with Microsoft to accelerate conversational AI. Okay, well. Let's see why this earnings was so good. I think they beat top line, bottom line, growth is accelerating in high margin areas. $1.3 billion, up 15% year over year. Okay. Twilio. This one stock can change early buyers' lives. This is not financial advice, but my research suggests it's a good idea to buy as much as possible before November 26th. The company is Twilio, ticker symbol TWLO. They do have a multi-year partnership with Microsoft on developing AI. Microsoft, of course, connected to OpenAI. Sorry for touching the microphone there. And they have significant revenue growth in the voice AI space. So that's part of why the earnings reaction is so awesome. They do have over $1 billion in revenue and year-over-year growth of more than 20%. So the ticker is Twilio. Let's jump into why this is the AI stock that is a good buy right now.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
So here's that revenue up, less than 20%, 15% year over year, but well over $1 billion. And notably, they've got accelerated growth in AI-powered communication. So if you've heard of Twilio, they're used by developers and also enterprises for anything automating phones and phone sales. So, for example, 1-800-Flowers could use Twilio for their vanity phone number. Anytime someone dialed that number, it could set off a sequence of automations to follow up with that customer, to send that call to a certain call center. Twilio does all that with a sequence of API calls. So there's a lot of automation. AI is not exactly what that was or is. That's still a big part of their business. But you can imagine with voice AI and with Microsoft's help, Microsoft being synonymous with OpenAI for the time being. I know their partnership is now changing, maybe becoming less long-term. OpenAI has a little more leeway to get compute from other big tech companies, which Microsoft gave them that option. So Twilio can basically use OpenAI voice type technology, which is a big deal because they are the brand name in sales software. So this is the ticker. That's a little bit about what we're looking at here, but significant sell-off in Q2 earnings, okay? But now we're coming back to that level. So it's an important time. Big move up on earnings, pull back, which if we look at some other companies after earnings, AMD sold off on earnings, came right back. It's very normal for companies to pull back, have some profit taking on earnings. Apple as well pulled back significantly, now moving up. So this pullback on Twilio, pretty minor. And if we look at the last couple of days, very tight today. It was a red day in the SPY, so a little selling off. But this is definitely an important level, this 130 level, going back to that Q2 earnings. If it can get over 130 and change, really 135, then there's definitely a lot of blue skies up ahead. So that's the setup. And if you want a specific level, it's got to be this close right now, 135 on the dot, which does in fact go back to Q2 right here. Okay, right there. So that's Twilio. That's the idea. And you might say, well, Twilio is a huge company. I mean, surely there's some other voice AI companies. I don't know if you were thinking that or not, but there is. You've probably heard of SoundHound. This is similar to 11 Labs. They do like the voice for, say, Taco Bell or Sonic, so you can order without talking to a customer. Putting aside that some of those voice systems are getting rolled back, this company sold off significantly. It's not really that interesting after the sell-off on earnings as well. And then if you want to take, SoundHound's brother, big brother, AI, this could go at some point. The earnings reaction's solid. It's definitely on watch, but it's not really, it's just a little bit speculative. So Twilio is in that basket of stocks that seem to be working right now, which is those high volume closes, earnings reactions that run. GM continuing to move up here. Ford starting to move up more as well. So definitely the automotive stocks getting a bid. Tesla still hanging out, but not breaking down. So with all of that backdrop of solid earnings reactions being the best pattern right now, Carpenter as well as CRS holding that level, you have to think that this level is also important for Twilio right here. So if we can get above there, it's super interesting. Could take a couple of days, could take a week, I don't know, but definitely important to keep eyes on that. So a little bit more about how they're basically moving into AI. If they can become an AI agent leader, they're one of the few companies that is incredibly clear how they would use an AI agent, because they already basically have a bunch of automations. They're a lot like this company Zapier, because they have Zaps. It's basically a no-code automation platform. So that's what you do. You drag boxes around. Anyone can do it. And then they connect, Google Docs to Google Sheets to Twilio. Twilio can connect to this as well. So, and of course, now they're connecting to the LLMs as well, Claude and Perplexity. So Twilio definitely in the AI conversation. And they're that nice mix of a software company that is already well positioned for AI. So you don't have to make a bet on Salesforce getting into AI that's down super, super heavily like that. You can just buy the company that is established, but also it's very clear how they would move into AI. So that's the idea. If you like these ideas, hit that like button. If you want a free course on how to buy stocks before they go up, hit that subscribe. And if you want a free trial on the best stock idea of the day in a one-on-one Discord room, head over to stockscommunity.com.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
Okie doke. What else?
You. For folks that really want to grow their account and are comfortable with volatility, this is going to be a fantastic time, probably one of the best ever. You're going to see 2026 is going to be incredibly volatile, way more volatile than 2025 was. You're not going to see a consistent straight up line. You're going to see aggressive dips. You're going to see aggressive tests. You're going to see people fear-mongering about valuations at every new high. You're going to see Trump tweets cause mega crashes and corrections over and over again. Not just one, not just two, but many different ones. Because people are going to become way more sensitive in this new margin environment. People are going to become way more sensitive because valuations are going to be climbing. People are going to become way more sensitive because
Sounds
every dip is going to
stressful.
completely blow up some of the folks that were too aggressive into margin. So anyways, how do you protect yourself in this coming environment? Well, for starters, buy great assets at solid prices over time slowly. Don't change your opinion because of stock price fluctuations. Focus on the business versus stock price arbitrage. Most people look at a stock as an indication for how a business is doing, whereas you should actually be flipping that. You should be looking at the business as an indication for where the stock price is at. And if there's a mispricing, well, that's an arbitrage opportunity. Thirdly, you got to use volatility to your advantage. If a great asset
All right. I do like that idea. So, Dave, the fintech app, some competitors. Revenues up year over year. Let's take a look at this. %60 year over year, 150 million revenue. Okay. Partnerships with MasterCard. MasterCard is going to power its debit cards and support its banking services. Okay. Okay. $150 million of revenue is up 60% year over year. About almost 3 million monthly transacting members. Okay. This one stock can change early buyers' lives. This is not financial advice, but it could be a good idea to buy as much as possible before November 24th. The ticker is Dave. It's a fintech app, and they had 150 million in revenue, up 60% year over year. They have 3 million monthly transacting members. So this isn't like Meta, where they have 3 billion members, but they're making money off ads. This is a membership of people actually using this debit card. The debit card is through the MasterCard network. So a lot of these fintech apps, they're not FDIC insured banks, so they partner with those banks. The partnership with MasterCard is a big deal to use their payment network. Of course, you want to have a MasterCard debit card so you can use it everywhere. This really has helped Dave expand And right now the chart looks like it's at a favorable level to buy. This thing has been consolidating, building a base. It's going to go up at some point. Could be a good idea to buy early. Not financial advice.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
All right, so here's a little bit about what they're up to. They're banking the unbanked. Growth in average revenue per user. They're taking the users they have and squeezing more revenue out of them. So that's a little bit about how they're different from fintech apps that maybe haven't really made it. They do have some advanced AI for fraud, credit decisions. Of course, fraud, what nearly took down PayPal in the early days. So this is a pretty big problem to solve for all fintech companies. They did raise guidance, which is part of this move. It's not just the growth in revenue, but this revenue is a big deal. The reaction is not crazy. I mean, basically, failed and then moved up and then went down and then is sort of just going sideways. So it's not overwhelming, but it does create a very clear base where I'll be honest with you guys, and you can corroborate this by your memory. I was talking about this stock here, and that breakout never materialized. It's hard to guess exactly when these big bases are going to go, but it's undeniable that this stock is just sticking around, and it is forming higher lows. 2 higher lows here. I mean, they're pretty similar, actually. It's just sort of sideways. But so I don't know that it's going to go right now, but I do know that at some point this thing is going to go to 300. I can't guarantee it, but it certainly looks like it's happening. So this is the most recent earnings per share beat, pretty massive earnings per share beat, and anything could happen. There could be all sorts of activity. I mean, everyone wants to get paid early. That's the big value of Dave. But at the same time, that does kind of border on some other activities. Everyone hates on merchant cash advances, which is the business loan, get paid early version for businesses. But you know what? Who likes them? The businesses who then are able to not, if they're going to go out of business anyway, and they can take a merchant cash advance to stay afloat. No one else is offering the money. So it is what it is. It's a fine line, but it's above the board for the reason that startups need money, and this company is helping them with that. So, well, actually, this company is just helping individuals with that, but you get the connection there. Here's the deal. There's a lot of other companies that are sort of in the same ballpark, the buy now, pay later ballpark. So Affirm is a certain winner that's just sort of taking a while to rebuild. Upstart as well, we can look at to just see the strength of the sector, which is not good, okay, in Upstart's case. But what you have to decide is, if you really want the strongest sector, right, you would just buy the banks, okay? Wells Fargo's doing well, Goldman Sachs is doing awesome, Morgan Stanley's doing awesome, Interactive Brokers is doing awesome, okay? But they move really slowly, so that's why you start looking at a company like Dave that moves about 10% a day. If you want a big growth in your account, you have to look at stocks that are volatile. It is what it is. So is Upstart a vote of confidence for the sector? No, but Upstart also arguably is a little more in the personal loan space, similar to SoFi, which is actually doing pretty well. A fintech app that maybe is a little more similar and actually is starting to turn up right now is Chime. Okay, so this one hasn't been doing well, but this earnings reaction does have solid volume, so there could be some buying activity into this theme. into mid-November. So definitely keeping an eye on it. Keep an eye on Chime as well as Affirm. Dave's the idea. This is the actual earnings. These are some other companies that are similar. And I don't know what, these numbers are going to be next year. Could this be 4 million? It could. It's up over 15% year over year this year. Could they still have 100 million in the bank next September? They could. They've stuck around this far. If you look at a 5-year chart, they're down significantly from that 2021 level, but every big tech company is down significantly from 2021. So that doesn't really tell us anything interesting. We do know they have that 100 million. They aren't likely to raise cash. And they're got incredibly, this company. I won't mention anything about it. You can just take a look at it, and we'll leave it at that. Interestingly, they actually are very good venture investors despite the obvious drawbacks. So that's the company. Dave, if you like this idea, hit that like. If you want a free course, hit that subscribe. And if you want one-on-one help, head over to stockscommunity.com.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
All right, so what else has Charlie got for us?
Gets oversold, buy it. If a great asset gets overbought, sell or trim it. And lastly, if you see rapid growth or rapid destruction over a short-term time span, don't feel too good or bad about yourself, because long-term real value shines through. You can get lucky or unlucky over a short time frame, but if you're buying good assets at good prices over time and you stay with your convictions and you adjust your convictions for the times that you're wrong, well, long-term, those good practices will shine through. And finally, one big warning for 2026. Do not trade with money that you can't afford to lose. And that also means don't trade with money that is so much of your bigger picture that you won't be able to stomach inevitable swings. Because again, the people that do these two things are going to be absolutely destroyed next year. Because
Okay, Bloom Energy, pretty comfortable with this company, so we can just jump into a little breakdown right now. I do want to look into a little more, talk about what Bloom Energy does. I wonder if these other LLMs can help us out a little bit here. I do think this is the actual only company that can supply power to data centers in the way that they are doing so right now. So it's pretty incredible what they're up to. Oh yeah, Plug is a good comparison as well. And then I think they have a connection to some big companies. So data centers need 35 gigawatts of power. That's a lot. Oh, they do have a direct deal with Oracle to power data centers. Okay. Recent earnings was strong. So let's take a look at those earnings, make sure they were very strong. 500 million, up 57% year over year. Hey, how's it going? Sorry about that, just saying hi in the comments. This one stock is about to skyrocket. The company is arguably the only fuel provider for data centers that can get going quickly. Sorry for hitting the microphone. what they do is they set up a mobile setup near data centers. They actually have a partnership with Oracle, and they'll take biogas and convert natural gas as well into electricity on site. So you don't have to wait for nuclear power plants to get built. You don't have to get the whole not in my backyard crowd all riled up. Bloom Energy can generate electricity quickly without creating a lot of buzz. And there's going to be 35 gigawatts of data centers expected to be built out in the coming years. So this company is up a lot. I expect it to be up a lot more. Recently had a pullback, which in my opinion presents a buying opportunity. This is not financial advice.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
So here's Bloom Energy's results. 500 million in revenue, up 50% year over year. And the gross margin improved as well. So sure, they're losing money, but they're also announcing these massive backlog deals. I mean, $5 billion to deploy their fuel cells for data centers. This is crazy. 2 gigawatt annual production capacity, which is, not going to do the whole 35 gigawatts the data center is expected to be required, but it's a lot. It's a big deal. And these little insider sales don't mean anything. I mean, what is that? 20,000 times, like a couple $1,000,000 maximum. So the big question that everyone who's familiar with this company is asking is not so much about the net loss, because we understand how that's going to improve, but more so the actual price. So here's the company. It's in the stratosphere for sure. But you know what? If you looked at Palantir, you would have said that in 2024. You would have said that in June, and you're probably saying it again. I mean, this company will not quit. So price to earnings, discounted cash flow valuations, PEG ratios. These are fantastical inventions that do not apply to the current market as much as they are necessary for anyone who is trying to be a long-term investor. So this is the company, this is the pullback, this is the current level. And you can see every time this stock is pulled back to this red line, which is a 20-day moving average, it is what it sounds like. It's just an average that moves with the price of the stock. It goes up when it hits that level. So it certainly seems like a buying opportunity for that reason. And if we look at similar tickers in the fuel cell category, F-Cell comes to mind. They're not doing so hot. They're leveling off. Same deal with Plug, but interestingly, Plug does sort of present a buying opportunity as well. I'm not sure why my keyboard is all messy. It's because I'm looking over this microphone. I'll fix it. So here's the buying opportunity for Plug. Our earnings reaction just going sideways, very similar to Bloom. But if you're going to buy the one that goes up, you know what? It's Bloom Energy. So I'm not here to pick a long-term winner, but I do know that Bloom has been the winner so far. So they do stationary power, and Plug Power is more focused on transport and logistics. So that's a big, big difference, having that direct tie to data centers. Fuel Cell as well does utilities, and they're kind of similar, okay? But I don't know that they actually have any big partnerships comparable to Bloom Energy. So we'll take a look, but I think Bloom Energy is the main leader. This is what they do. I mentioned this. It's kind of sounds crazy, but you can basically tap into natural gas pipelines, and literally, I mean, there are spots where you can divert the gas, of course, and that's what they do. And every party gets paid, but they convert that on site near data centers. So you don't have to set up a power plant near where these data centers are built out. And when you have the entire GDP of the US hinging on AI, it's a pretty important part to have enough power to serve that. So that's why this company is just absolutely exploding. And this is that deal with Oracle. They do have, fuel cell energy is definitely being talked about as well, but it just hasn't had nearly as much buzz as Bloom. So I just feel personally, it looks like fuel cell energy could be a long-term competitor, but in the immediate term, it doesn't sound like F-Cell is going to be a big competitor. Personally, as far as what I've seen, this is the Oracle connection. This is the $5 billion partnership with Brookfield Asset Management. I don't know why this fuel cell thing is not coming up. Talk fuel cell partnerships for AI data centers. Guys, we're just making a mess for the AIs to clean up here. But look, this data center interest doesn't seem to be slowing down. They're pretty aggressive in providing this capacity. And these are big numbers. So they're looking for some more money, maybe. But if we actually look at what they've got going on, it doesn't look like they have a lot of dilutive instruments. So they're not going to be a problem in terms of buying this company and then having them, shell out, create shares out of thin air, making the price go down. So that's part of why the price has just gone up, up, up. Meanwhile, companies like, for example, MicroStrategy, they have been diluting and the price goes down, down, down. So that's a whole lot about Bloom Energy. Fuel cell, here's the best example. Yeah, South Korea data centers. So it's just not really in the same category. They're aiming at supplying off-grid power, but 360 megawatts doesn't compare to that gigawatts and that Oracle partnership from a cursory look at it. So that's the idea, Bloom Energy. If you like these ideas, hit that like button. And if you want a free course, hit that subscribe. If you want help, head over to stockscommunity.com.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
All right, let's jump into a little.
Because quite
Look
frankly, it's going to be a
at,
way more volatile year. Okay, next, I want to give you an update on a key
Lemonade.
play, AMD. So, stock AMD Advanced
JD
Money
is a
Dispenser,
cool idea in the
Advanced
China
Micro Devices.
category.
So, CEO Lisa Su says AI
the
business
comments,
is going to grow more than
unfortunately, the
60%
chart
a year for
looks
3
like
to 5 years. And a lot of folks are
dog
now
shit,
screaming about the
frankly.
stock. But for context here, I've been yelling hard
you don't
all
wanna buy
year about AMD,
right
and really
before
for
earnings
years
either,
about
so.
AMD and the lops.
In my opinion. But I do think the China sector as a whole is really interesting. So, hope that helps. Let's take a little look at Lemonade. Whoops. Yep. Little concerned, Lemonade, given that they're unprofitable, but they're also basically an ad arbitrage company, which means they don't have overhead. So, you know what? I'm not saying that they're always going to be unprofitable. I'm just saying it kind of makes you wonder. And I don't really know what they use for AI that's all that innovative. I mean, companies were doing this a decade ago. But, you know, that's what they said about Dropbox. So maybe they just make it super seamless. Did raise their revenue guidance on November 5th, and this is where the company's at. So a little bit of a failed breakout today, but $80. Very clear level. Okay. Obviously, they have partnerships with all the big insurance companies. There is one stock that is about to skyrocket. This company recently added a senior executive in the AI. I think he's like a VP of product, or was at Meta. They added that individual to their board. So Meta, of course, very good at attracting AI talent, not necessarily the best at keeping it. This company, Lemonade, LMND, uses AI to make insurance underwriting decisions to say if this individual is qualified for this insurance policy. And they are unprofitable, but they raised their guidance on November 5th. And the stock's at a really important level post earnings that presents a favorable buying opportunity. So let's jump into the opportunity. This is not financial advice.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
Okay, so this is Lemonade. This is that VP of engineering for AI products. You know, that's a pretty significant add to their board, considering they are basically a startup. And yeah, they obviously have connections with insurance companies. They're a heavy direct marketing company, which is why, you know, it's a little concerning that they're unprofitable. But you know what? They could figure it out. They could turn the tables, turn the corner in terms of getting a little extra margin from the insurance partners side. I'm sure that's what the VP of AI engineering is working on, you know, how to make better underwriting decisions so they can get a better price from the insurance giants, Geico, Progressive, etc., if they're able to actually provide better leads. So even if they're not as good at making, you know, they have to be very careful with compliance too for their advertising because they're a huge company. And the guidance raise is also a super super green light. So we'll see. This is not a crazy sale, but it is right bordering on a level that's notable, definitely, for an executive, around the $70 level for that sale. And then as far as what this company is up to otherwise, 30% year-over-year growth in premiums written. I believe that's what that means, in-force premiums. Gross profit up 100% year-over-year. And customer count is up 25%. So that gross profit is not notably meaning that they're a profitable company, but it does mean that they're moving in the right direction. So this is the company. They do offer insurance in Germany and the Netherlands and France as well. So they can do their ad buying in these other countries, which do have lower ad rates, although they're still very mature markets, Germany being the biggest one in the in Europe. So again, the AI angle is definitely interesting, but it would be great if the losses could narrow so much that they actually make money. So we'll see what happens. Fortunately for us, we don't have to be betting on this company's next year. We really just have to bet on the next month or so. And it's not really a time-based investment. It's more of a specific level-based investment. And can see that super clearly here. Here is the close. Significant buying activity, accumulation right after the earnings were announced. Earnings were, the guidance was solid, so people want to own the stock. And sure, there was some profit taking, sell the news, but it's getting up over that $78 level. And people definitely want to own this, despite the failed breakout today. Again, I've mentioned this, but today was a red day, so. Of course, Bitcoin and Ethereum looking terrible. Money is definitely in these earnings reaction stocks right now. So Lemonade being sort of at the head of that snake in terms of recent earnings reactions. It looks really similar to Twilio. A little profit taking and then some support. So definitely want to watch this level. And when we compare it to other opportunities, I mean, there are some other opportunities, but they're slow. I mean, Caterpillar, same thing. Earnings reaction, little pullback, holding, but it moves 3% a day, right? So it's interesting, but Lemonade moving 10% a day, of course, that being helped with this big move. You got to put your money somewhere where it actually moves. Otherwise, you're going to grow old before it does anything at all. This stock could, called Caterpillar, could go sideways. I mean, it probably won't. It's had a huge run, but it's not the fastest mover. It's silly because Ford is also a great opportunity right now, and as I've mentioned, but these stocks do move really slowly. So it's almost a little hypocritical to be talking about how these are good ideas and at the same time saying that, stocks that have had huge moves up like Goldman Sachs were not good ideas. When in fact, 5% plus 6% in, a few days at a really smooth move. I mean, that's pretty interesting. So you do have to get a little creative in times like this when a lot of the speculation names are pretty just beaten down. Kohl's is definitely interesting as well. Some of these retail names are interesting, but you got to balance how slow they move combined with, how safe they are and how attractive sort of the flags they're building out are. So this is the idea. Lemonade, there's a lot of stocks to pick from here on this list that could be good ideas, but some of them, frankly, have already gone up. Gold being one of them. Now it's in no man's land. So let me know if you like this idea. Hit that like button. If you want a free course on how to buy stocks before they go up, hit that subscribe. And if you want one-on-one help and you want to see how a couple of our superstars have performed, head over to stockscommunity.com. $25. What is that? A couple pizzas? Not financial advice.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam